Hey, I'm Jaden, and this is where we dig into what is actually happening in the market. The data, the options flow, and the setups nobody's talking about. Every week, I run a 7-point squeeze scanner across the highest short interest stocks on the market. This week, one name lit up 5 of 7 signals. SELLAS Life Sciences, ticker SLS. 32% of the float is short, borrow rates at 13%, and the options chain is screaming. Not financial advice. Let me show you what the data says. Here is how a short squeeze works. A short seller borrows shares and sells them, betting the price will drop. But if the price goes up instead, they're sitting on a growing loss. At some point, their broker forces them to buy back. That is a margin call. Here is the key. Their forced buying pushes the price higher, which triggers more margin calls, which forces more buying. It is a feedback loop. The squeeze doesn't stop until the shorts are done covering. Days to cover tells you how long it would take for every short seller to close their position, given the stock's average daily volume. SLS has 63 million shares short and trades about 9 million shares a day. That is 6.7 days to cover. Think about what that means. If every short tried to buy back at once, there literally aren't enough shares trading each day to let them all out. They'd be stepping on each other for almost a full week, but days to cover alone doesn't cause a squeeze. You need a catalyst, something that forces the short's hand, and SLS has two. First, a phase 3 clinical trial called REGAL that is 2 events away from releasing results. If those results are positive, the stock reprices overnight. Second, the company just filed executive severance amendments, which is Wall Street code for we might be getting acquired. Look at the chart. SLS sat around $4 to $5 for most of the year. Then in late June, it broke out from $7.68 to $15.45 in 2 weeks. That is a 72% move. Volume exploded from 5 million shares a day to over 30 million. And here is the thing. Despite that move, short interest barely budged. The shorts are not covering. They're doubling down. That is either conviction or desperation. Now look at the options chain on a normal stock call and put implied volatility are roughly balanced. On SLS, the July 24th expiry shows 25 delta call IV at 633%. Puts 281. That is more than a 2-to-1 skew toward calls. When you see call IV that far above put IV, it means buyers are paying a premium for upside exposure. They're not hedging, they're positioning for a move higher. The options market is telling you where the smart money thinks this is going. Here is the full 7-point checklist. Short interest above 40% of the float. SLS misses at 32. But it is close days to cover above 5. Check 6.7, borrow rate above 10%, check 13.25. Binary catalyst, double check, phase 3 readout, plus M and a speculation. Call skew above 1.5 to 1. Check, it is at 2.25 to 1. 30-day price momentum. Check, up 72%. Insider lockup expiry. Miss, no lockup catalyst. 5 out of 7. That is our top setup this week. Compare that to Groupon. On paper, GRPN looks better. Almost 60% of the float is short, 11 days to cover. But the borrow rate is 0.5%. Shorts aren't paying anything to hold their position. And the options chain shows put skew, not call skew. That means the options market expects downside, not upside. High short interest without pressure is just a number. SLS has the pressure. If you wanted to play this, one defined risk approach is a bull call spread. Buy the $14 call, sell the $20 call, July 24th expiry. For a $1.10 debit, max risk, 110 max reward, 490. That is a 4.5 to 1 reward to risk ratio. Break even is 15.10. SLS hit 15.45. Just 2 weeks ago. You're not betting on a miracle. You're betting it revisits a price it already hit. Let me be clear. This is not a recommendation. Biotech squeezes are some of the most violent moves in the market in both directions. If that phase 3 data disappoints, this stock goes back to $5 and your calls expire worthless. That is why the spread caps your risk at $1.10. The scanner identified SLS because the data says it. Short interest, borrow costs, options flow, price momentum, and a binary catalyst, all pointing the same direction. Whether you trade it or not, now you know what a real squeeze setup looks like. That is the real story. Now you know how it actually worked. I'm Jaden. Thanks for watching.